On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and I would expect very warm Scottsdale, Arizona.
It's 72 degrees, okay? You're in Buffalo. What is it, minus 20?
It is actually, we're getting a warm front. I think it hit 50 today. How about that?
Well, we shouldn't be doing TV. You should be running naked around the park, for crying out loud.
Yeah, right. Maybe I'll go for a nice walk after the show.
Yeah.
But with us today, our featured guest is Jose Torres. He is the senior economist at Interactive Brokers. And Jose, welcome to Buy, Hold, Sell.
Thanks so much for having me, Todd. Hi, Toby. Great to be here. Looking forward to discuss Trump tariffs on this Tuesday.
Well, let's get right into it.
How about that alliteration? Trump Tariffs Tuesday. Trump Tariffs. I see a T-shirt, Todd.
There you go. Well, while this show, we're at the top of the hour, we're going to have the president's going to be speaking to a joint session of Congress, and the number one topic has got to be about the tariffs. We've seen the Dow lose 1,300 points in the past 2 days. Not a good way to start March at all. Historically speaking, you usually see the markets move a little bit higher at the beginning of March. But Jose, what's the deal with the tariffs? Is it going to be good news, or are we just going to be continuing to sell off?
Let me just hold my head, Jose, because I've been shaking it so hard today. Can you help us?
Todd, Toby, initially, we expected the tariff talks to be more of a negotiating tool, similar to the debt ceiling negotiations. They go down to the wire, some kind of deal happens, and then the tariffs are postponed or we forget about them. But on this Tariff Tuesday, we have implementation, 25% pretty much across the board for Canada and Mexico, 20% pretty much across the board for China. Canada, an important exclusion there is energy supplies. Now, why is the market selling off? Well, we started off the year with valuations extremely extended, roughly 21 to 22 times forward earnings, depending on who's estimating them. 2023 and 2024, we saw returns in the S&P 500 of roughly 25% each year. So we're coming into 2025 extremely buoyant. So
that's a nice word. I would say way overvalued, but go ahead.
So we're coming in way overvalued, Toby. Are you happy now? Way overvalued.
Todd, I'm giving him every shot I can throw, and he's taking them. I love it.
He's great.
.com like price to earnings multiples. So can you stay at those levels of valuations? Sure. If earnings grow, if rates remain somewhat steady, then we could get 10% returns roughly in the S&P 500 this year, finishing at around 66 or 6,700. Now,
which is the average annual since 1957. I know that because I was born then. Okay. Yeah. But what do you? But the bigger issue I think is nobody. I mean, I manage money. I used to run a hedge fund. I do mutual funds. I've done all that stuff. When you're confused, when things you've never seen before happen, and then you see the market open up, Dow 900 points, the S&P down 2.5%. You like to think that would be a buying opportunity, right? And we had this weird thing on Friday. Oh my God, where all the index funds had to buy all the shares to get back up to their end of the month thing. But from an economic standpoint, what's your feeling about? Because what I'm hearing now is, well, the R word was off the plate for a long time. But if you take this amount of capital out of the system, you take this and raise prices this much on consumer inflation, since of course everybody other than the president understands that a tariff is just a price going to the ultimate consumer. What's the odds you think of recession here? I mean, that we got the government going to lose 200,000 people, blah blah blah. I don't want to be in the state of Virginia right now, but if the other parts of the economy start to have a knock-on effect, give us your take, Mr. Economist.
I'm a little high here at 35% chance of recession this year.
Okay.
Initially, I had a very robust economic outlook, and the economic tailwinds that I envisioned were lighter taxation, a milder regulatory regime, and a push to onshore manufacturing. But an important ingredient there, Toby and Todd, was trade acquiescence, right?
Yeah,
and that's not what we're seeing, right? At the same time, folks, we're seeing that the consumer could be exhausted. Now, I don't want to take 1 month's data and
extrapolate it over
and come up with too many conclusions. Last year, consumers were managing their budgets like light switches. 1 month, 2 months, they would spend astronomically only to retreat sharply the next month in order to maybe replenish the finances and then continue spending the next month. So maybe after a strong holiday season, that extremely weak January was a one-off. However, Best Buy and Target today did mention that February was particularly weak. We have those government spending reduction plans, downsizing the government, like you said, Toby, 200,000. But what are the implications for the vendors of the federal government, for the contractors of the federal government? We're not conditioned to having an uptick in employment in this kind of economy, while at the same time we're seeing austerity measures trying to be implemented at the Treasury. So slowdown concerns are significant. In terms of earnings, right, if you don't have the consumer powering through, that pressures the revenue side. And then with tariffs, of course, that's going to pressure the cost side. So really in a margin compression story here if trade deals aren't managed with adversaries and partners.
Yeah. Well, I mean, we have a couple things, obviously. I talk about this all the time. We have the top 25% of households who now it's even a stronger number, Todd. This last week on Friday came out that the top 10% of income houses are now 50%, 50 of discretionary spending.
Wow.
So if you take that number, then the economy is in the hand of the top 10%. Now the top 25% are now responsible for 78 or 79% of discretionary, actually more than that, up to 90%. So you take the top 25, that's 90% of discretionary spending. My question is, sir, when those, Silicon Valley's laid off almost, 200,000 people in the last 12 months from, downsizing and right sizing and all that stuff. Let me tell you right now, that's where a lot of the top 25% is living. You look at New York, you look at other big centers, other than Miami. Miami's doing great. God bless Miami. But many large companies are in the, hey, you know what? Let's rationalize our workforce on the margin or at the margin, depending on what economic school you went to. I'm a little concerned that we're totally on that. And then, of course, then you saw, airlines take it. We have, the cruises that all the high-end people are doing that got hit. I'm seeing stuff saying that if we don't get the top 25% staying, right where they are, and a lot of those people are federal workers, by the way, that on the margin, that's where we get the reduction. Am I smoking the wrong grass or what?
No, I think that's absolutely the case. And not just the job losses, those folks at the top 25, they also hold a lot of the equities,
sure,
as a share of the market. Right. So the wealth effect. So, a lot of folks, stocks, bonds, they're liquid. So folks look at their phones, they look at their computers and their portfolios. And when they see that number rising, they go out there and they embark on discretionary adventures and they spend, they purchase stuff, they buy stuff. They love to do that. If they start to see those numbers begin to go down, while at the same time, Toby, the job pressures that you're talking about do manifest, you could have a reduction there, and that would be significant.
Yeah, it's just a disproportionate part of the deal. You lay off 1,000 people who make $12 an hour versus 1,000 people who make $280 an hour. It has a big effect, and I'm totally with you on the wealth effect. Not really here in North Scottsdale, you know what I'm saying? Because everybody who moves here already brought their money, and they own everything for cash. And try to get a reservation at a restaurant. It's almost as hard as being in downtown Miami. But
it's the new Beverly Hills, that's for sure. So, Jose, I have to ask, because that 35%, I have not heard an economist be I'm going to say pessimistic. 35% chance of a recession in 2025. We have only 3 quarters left. hard to imagine. And I expect a lot of that has to do with these tariffs. So what the audience wants to know, though, and I think Toby and I want to know as well, is for the short-term pain, will there be any long-term gain with what's taking place right now?
Well, there's going to be some bright spots in the economy, right? If we have a recession, that's actually going to be really buoyant for the real estate sector, believe it or not, folks. Rates are going to come down, and that's going to push transactions north in the real estate sector, which has been disconnected really from the employment market overall. Also, the manufacturing sector, another rate-sensitive area, that area that President Trump is really focused on, that area is also going to improve with lighter rates. And as far as the medium-term, long-term benefits, you know, from 1979 to today, we're short 6.8 million manufacturing jobs. So if we can get 2 or 3 million of those back, maybe in the next 2 or 3 years, you know, I think that's going to be a policy win, because that's going to diversify our economy, add more diversity to our sectors, not so much a services-oriented economy. Still heavy services, of course, for a wealthy country, but we're going to have some manufacturing, some goods-producing activity as well. As far as some hard data points that I wanted to mention that we haven't mentioned before to inform the recession call, you know, retail sales contracted the most in January, 22 months. When you look at and that's heavily goods, so you have to wait about 2 weeks for the personal income and outlay survey to come out. That comes out with the PCE inflation. That covers goods and services. Sharpest contraction, folks, 47 months. You got to go back to February 2021, right? So we're seeing some big contractions in consumer spending. When you look at the labor markets, the average hourly work week is down to 34.1. Before March 2020, you got to go back to 2010 to see a number that low. What's the rationale there? Before employers begin to reduce rosters, they start cutting hours first. And then the composition of job gains has also been less cyclical, more towards the non-cyclical aspects, you know, and that all points to the potential for a slowdown this year.
Well, those are the great numbers, and a lot of people don't look at everybody's looking for the big shock, but it's the squeeze, you know, one here, here. By the way, Todd and Jose, I don't know if you know this, but you know, harvest season is coming, and robots are going to do all the picking of all the lettuce down here in Arizona, and you know, I'm kidding. But who's going to pick? They just deported 12,000. You know, labor, Texas, Florida, Arizona, etc. I have a really good friend in the you know, these guys inherit 4,000 acres down in Bufu nowhere in Arizona, and they grow lettuce, and they sell it all over the United States. This guy's name happened to be Todd, and Todd says, I have no idea. We used to have this system in California where you got a seasonal permit, and that's how, you know, fruits and vegetables and everything else. Does that impact our world here, Jose, in terms of the, you know, the transitory labor not being here in the United States?
Absolutely. I think it impacts us. Let's talk a little bit about inflation. You know, we've had a tight labor market here for a long time. Back when I was at the Bureau of Labor Statistics during Trump 1.0, one of the main topics of discussion was, how can we fill the job openings that we have? So that's back then. Then you had the immigration restriction that occurred during Trump 1.0. You had COVID, and they had the excess retirements. And then now you have more immigration restriction driving a tighter labor market. So I think that's going to drive wage pressures higher. It's going to weigh on productivity in a lot of those ag sectors and those construction areas as well, where a lot of those workers were laboring. You know, so I think it's upside inflation risk on the wage front, but that could be countered by lighter shelter expenses, right? Because those folks, they were living and you know, absorbing housing supply and bringing down vacancies. So, you know, we could have some kind of shelter alleviation. But Todd, we didn't see it in January. Shelter re-accelerated. We saw November and December, we saw a slowdown in shelter expenses that made us really happy, because it's a 40% roughly of the CPI, and we saw that pick up steam to roughly 40 bips in January. That's not what we want to see.
Hey, Jose, by the way, Todd, this guy knows his shit.
Oh, he does. Yeah.
my most hated part, of course, of the PCE and every other measurement of inflation is the shelter cost, where somebody calls me, if they would call me, because I wouldn't answer the phone, and they would say, what can you rent your house for? What do you think? And then therefore that gets imputed. They called random, 5,000 homeowners, and they asked them what they could rent their house for.
Yeah.
I mean, it's so wrong. I mean, now, why wouldn't you go on Zillow and look exactly what the house would rent for? Because they have it all. Daniel, why would you ask the homeowner? It bugs the crap out of me. What do you think? Am I just being an angry old man?
Yeah, no, you're not an angry old man, Toby.
I didn't ask you, Todd.
You're not angry.
You're a handsome young man, Toby. Handsome young man.
He's coming back, Todd. He's coming back.
He is definitely coming back. And we always bring the All-Stars for they're on all of our programs at Biz Talk Today. Real quick, Jose, before we go to the break, I have to ask you, though, because everything you're talking about with retail sales, the slowdown in January, all of the metrics that are there, do you believe, what's your opinion? Do you think the Fed started a little too early in their easing cycle?
Absolutely. No need to start with a supersized 50 basis point reduction in September. Really force them to cut again in November and December, because how could you cut 50 and then not pause the next meeting, right?
That would be oops, we made a mistake. Just don't look back there. Don't look back there.
Right. Yeah. It's a pigeonhole, and it's hard to say that it wasn't politically motivated, Todd and Toby.
Yeah.
Yeah. Oh, that's a whole other topic for another show, that's for sure. But listen, let's close it out on that block, guys, because coming up after the break, we're going to ask Jose, we're going to stick on that inflation topic. We're going to talk about the Target and Best Buy numbers that came out today. And we got to really bring up the non-farm payrolls report that's coming out on Friday at 8:30 New York time. We have a whole lot to get to, whole lot that's happening on Tariff Tuesday. So we hope you stay with us on Buy Hold.
Tariff Tuesday.
We'll be right back after the break.
Buy, hold, sell, brought to you by CrossCheck Management.
Hi everyone, I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
Welcome back to Buy, Hold, Sell. Well, with us today is Jose Torres. He is the senior economist at Interactive Brokers. He's also a lead contributor for the Pro Investor Insights newsletter, with the next edition coming out on the 15th of the month. You definitely want to subscribe to that and read more of what Jose has to say about the economy, because he's giving us so much today. Jose, when we left off in the last block, we were talking about inflation. The PCE number came out as expected this past Friday. There is this feeling, though, that the inflation is starting to bubble up again. Yet, in your report today on interactivebrokers.com, you actually wrote that you're still expecting more Fed rate cuts this year in 2025. Can you explain?
Sure, Todd. Well, I think that the economic slowdown worries are really trumping the inflation concerns. That was a good one, right, Toby?
Yeah.
So, if you
have an economist with a sense of humor, Todd, this is the first.
Great.
I mean, this is literally a first.
So when you have the economy slowing down, fellas, Atlanta Fed's GDP now is at negative 2.8%, right?
Yeah.
That's quite significant. Of course, very volatile, but it's almost at 3% to the downside for this quarter. So that in itself has a deflationary, disinflationary aspect to it, right? If consumers stop spending like they did in January and they do that for a few more months, then companies aren't going to have the pricing power. They're going to have to take the hit to margins, and they won't be able to pass higher costs on to consumers. Also, drill, baby, drill, that's occurring alongside oil prices that are already coming down. They are also worried about the demand concerns. Also saw the same dynamic today with copper. Now, lumber and gold, lumber up significantly, roughly to a 2.5-year high, and gold near all-time high. Lumber because it's a critical import from Canada, and then gold has the safe haven properties that folks, are really chasing. So that's the activity we saw today. But folks, today in the morning, it was quite significant. You saw a bull steepening across the yield curve led by the short end. People really dove into the 2-year and below maturity structures. And really, with the level of buying that I saw, it was almost as if rate watchers were yelling to the Fed that we need rate cuts right here, right now, or else we're going to have some trouble. That's really what I saw.
Yeah, 10-year at 4.1. It was 4.8 9 months ago.
Yeah, and weird, a lot of moving parts, but the long end I think has been moving down because of reduced growth expectations as well as lighter term premiums. The reduced growth projection, we spoke enough about the consumer, you already heard that, but with the reduced term premiums, there was a thought process that the Trump administration wouldn't be able to maybe get a lot of these government spending cuts done, but now with the motivation and the enthusiasm of Doge, Elon Musk, Secretary Bessent, Secretary of Commerce Lutnick, they all seem like they're on board with these government spending reductions, and that's really bringing down term premiums. But Toby, so glad you mentioned that, because we've been seeing a lower profile on the yield curve, really led by the long end in bull flattening fashion. But this morning we saw a bull steepening led by the short end. So that's some interesting interesting dynamics for folks that like to look at the bond market.
Okay. Yeah, well, I'm just quickly, Todd, because I think I'm running out of battery juice. I don't know what. Jose, the idea that talk about knock-on effects. There's always the second derivative, right? There's always the effect of the effect. And when you get in, it takes like 3 months to actually see these tariffs, right? Maybe even longer, depending on what's going on. Then all of a sudden, then prices get marked up ahead of the tariff because nobody's wanting to wait till everybody sees the blood on the floor. They just raise their costs or raise their prices, anticipating it. And then you get that negative feedback loop where, okay, I'm not going to get it this time, or I'm not going to do this, or my lumber now is going to cost $5,000 more to build a house. On the margin, at the margin, the decision making, when does it start to kick in with these tariff rates?
Well, you heard from Target this morning. They're going to start increasing prices next week.
Absolutely.
To your point.
But the thing about, okay, let's pivot to that right now because we teased it going into this block. But Target has a history, especially with their leader Brian Cornell being there. They had a mandate that you had to retire by 65. The guy's 66 and he's still in charge there. And he always has an excuse. Before it was supply chain issues, which is explain why they had so much inventory. Then it's unrest in the Middle East. What that has to do with buying mayonnaise and shirts at the Target, I have no idea. And now he's blaming tariffs. So they're instantly going to start adding prices, even though all the goods and items are already in the store and have already been paid for. I mean, how many companies right now, Jose, are going to actually use this as an excuse just to lift prices?
Jose, I just have to say this. You have to understand, for some reason, Brian Cornell did Todd wrong a few years ago, and he's been on the warpath ever since. I mean, it's really sad to see. I'm just saying.
But Jose, you go.
Hey, Wall Street's an aggressive place, folks. Well, of course, those companies with less strong business models that are more vulnerable, of course they're going to use the macro environment as an excuse. Let's talk more specifically, though, why is Target having these pressures, right? Target is more of a middle class, upper scale kind of retailer, the kind of retailer that we've been seeing under attack in the last decade or so by e-commerce, by lower cost options, by the TJ Maxx's and the Marshalls of the world, by Walmart and Costco taking market share. So it's been very hard for Target to, maintain its sales even. I mean, now look at their guidance. Their guidance is flat, right? Same thing with Best Buy, different kind of business, but also sales being flat. But what does that tell you? If you're in an inflationary environment and sales are flat, that actually means that your business is contracting, right? Values are coming down.
They don't have pricing power.
They don't have any pricing power, and they don't have enough.
And I was going to say that Target actually today in their analyst call after the earnings release, they were telling analysts that they actually have a goal of $15 billion in new sales growth over the next 5 years. They're looking to add $3 billion a year in this environment. It doesn't make any sense.
Yeah. Smoke this, Todd. Really?
Yeah,
Come on.
exactly. That's exactly what I was thinking, and I think that helped explain the acceleration in the sell-off, because the stock actually in pre-market was only down after the report came out, was down 2.5%, and then suddenly it doubled that loss. And once they started talking about this crazy goal of 15 billion, so I just can't see it. But who knows? I don't know. Maybe they're going to turn them into Spirit Halloweens or something. I don't know.
Hey, Jose, I got to roll here. My last question to you is, I think you've really got a good handle on this. The risk. How do you value the risk in the market now with the opportunity in the market? Are you sort of at the same, or is it more risk, less opportunity?
I think there's definitely more risk, less opportunity. I thought today was a big technical recovery right off of the 200-day.
Yeah, right off the 200, the 200.15. It was incredible.
Yeah, no one's really quite sure why it recovered so strongly. Maybe it was Treasury Secretary.
Algos, 200-day algorithm.
Algos, but like you said earlier about the valuation perspective, valuations are quite stretched, and if you have any softness in earnings, the earnings picture, the earnings outlook, you could have a pretty big drawdown. Just a few months ago, the S&P was trading near 5,100. Yeah. So, during the August reverse carry trade. There's some risk there. I think the risk is definitely skewed to the downside. I don't think there's that much opportunity in the market as a whole. Now, some names are good, I think, good opportunities, but overall, I think the risk is to the downside.
Well, if you look at who's actually working right now, insurance companies are working. Why? Because they get to raise rates, right? They have pricing power. The thing that gets me is that the people who are prognosticating are not really being honest, because I totally agree with you. Is that if I went into this thing thinking, it's just bluster, Trump's just negotiating, he's the master deal maker, he's not going to actually do these stupid, ridiculous, so I'll stay long. Then he comes in and he announces all these in one fell swoop, and you're in the camp of, holy shit, he really did this? Then you're like, get me out. It's called Fido, get me out. And I think that's where we are now, is that we got to get out the people who didn't believe all this was going to happen. And then let's hear tonight how, what other tariffs he has.
Yeah, right about that. Listen, final question for you, Jose. So Friday, non-farm payrolls come out for February. You worked at the Bureau of Labor Statistics. The Wall Street estimate is 158,000. Based off of your history of working there, do you see the number being higher or lower than the one?
I think we're coming a little lower, Todd. Toby, I think we're coming in at 120,000. I think the unemployment rate ticks up to 4.1%. I think average hourly earnings stay strong at around 0.4% month over month.
All right, put that down, Todd. Take that in a little capsule, and we'll send it to him tomorrow morning.
Definitely will.
Or excuse me, on Monday. Okay.
We just did get some breaking news. Howard Lutnick at the Commerce Department just said on Bloomberg that he can see tariff relief for Canada and Mexico as soon as tomorrow. So I would imagine futures will be shooting higher tonight going into the president's speech.
Thank God, because I got seriously long into this thing. All right. Hey, Jose, you are el primo del mundo. Okay? You are fantastic.
Thanks, Toby. I think you just admitted that you follow the ADP jobs report more than the BLS one, by the way.
I do.
Because that was coming out tomorrow.
ADP actually has people. BLS has people phone calling. Sure, don't get me started.
There you go. That's a topic for another time. But listen, we want to close it out there, guys. Thank you so much to Jose Torres for joining us today on Buy, Hold, Sell. We cannot wait to have you back. And on behalf of Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.
If you like Buy, Hold, Sell Live, be sure to smash the like button.